Welcome back. You're still watching Metropole Television. This is your economic review. Now, latest CBK data indicates that the COVID-19 pandemic pushed the level of default in the transport and real estate sector to 100 billion in the 9 months to December last year, representing a 45.25% jump between March and December to 99.5 billion shillings. Now, the data further highlights that facilities through title deeds and motor vehicle logbooks experienced the fastest default growth rates, which are heavily coincided with travel restrictions in the country as part of mitigations to controlling the rate of infections in the country. Overall, the sectors were behind for 46.27% of the 67 billion shillings in new bad loans between March and December last year, with defaults in construction jumping 4.6% to 28.6 billion, pushing defaults in the transport and property market to 128.1 billion in December from 92.5 billion. Question this morning: is this a crisis in liquidity and asset quality in the banking industry? Joining us this morning is Gabriel Mwendo. Gabriel, that is the question to you, sir. Good morning.
Good morning to our viewers. So, just to answer your question, it is correct to say that we are going to be facing a liquidity crisis, but
yes.
In terms of liquidating the assets, but it's not really a question on asset quality. So let's look at sort of the report from CBK. So you see, typically in Kenya, how do you secure your loan? It's really mostly by title or a logbook, and unfortunately, for what I like to call balance sheet banks, banks that are just looking to grow their balance sheet without applying any special technical skill or applying any special due diligence skill. As long as you can provide sufficient security cover, you will be given a loan.
Yes.
Now, if you look at their typical customer, these are Kenyans. Kenyans are, the idea of buying a parcel here and there. So people have a couple of titles here and there. Whether those pieces of land can be sold or there's a market for them is never properly evaluated. As much as the bank does secure themselves by lending only up to 70% or 60% of the value, you see, as long as you can't get a buyer, you can't get a buyer. Now, if you do not properly assess the cash flows of some of these customers, you end up with securities that you actually cannot make good on. And I think that's what we are seeing. It's not a question of asset quality because these assets do have the value, but we are in a market in which people have reduced their cash outlays to long-term investments. So then no one is looking to buy this land. If you had plans to develop a home, those plans have been shattered because you're probably relying on the bank again to give you a loan. So then that's really the big problem. Now, the other thing with real estate that we need to understand is real estate projects. If we're talking about the big projects, they all have about a 1 year, actually about 18 months to up to around 30 months lag.
Yes.
So, for example, if I'm giving you a loan today to start a real estate development, if it's of a certain size, let's say over 100 units, etc., it's going to take you over 18 months to properly complete from groundbreaking, to get in the permit, etc. But you've already secured the loan. Now, picture it if you are making loan repayments from pre-sales. Now, those pre-sales, people are telling you we are no longer able to keep paying the monthly commitment before we take possession of the house. So that just further makes it worse because you are relying on these pre-sales and customer deposits to service the loan before you're able to collect the final money from selling the unit. And yeah, here you are now, people telling you they're unable to do this. So that's really what causes the challenges around real estate. For transport sector, it's pure and simple. It's a cash flow business. It's a daily cash flow business. There should have been no problems. But again, because of the lockdowns, as you can imagine now, if, for example, the biggest borrowers in this sector would be the long distance vehicle owners. So, coast buses, etc. So if they're not able to take people now from Mombasa to Nairobi, to Kisumu, Easy Coach, etc., then you can see where the problem comes in. And again, they were already suffering from competition from the SGR, and again, cheaper flights from Jumbo Jet, etc. So these are two sectors that have been hit very hard. And
Yes.
again, you and I have been told to be careful, travel less, keep it simple. So you see, these are the very sectors that are being hit the hardest. But I wouldn't say it's a question of asset quality. It's really a liquidity challenge we're facing because of the poor saving culture that the government has forced on us.
Pretty much. Let me read for you a direct comment from Abraham Dhogo, the CEO Miradi Capital. He's saying that we could be staring at about 54% plus. That if you add the 14% non-performing loan book in the economy, then that could be around 68% of the total loan book going bad, of worst case scenario. And it's saying that if this continues, and if we continue talking about lockdowns and restrictions within the economy in 2021, that only tier 1 banks could survive this sort of non-performing ratio of the loan book. Would you share the same sentiment, or would you like to differ,
No,
Gabriel?
yeah, I'd like to differ, Simba, for the reason that if you looked at, and I'm sure I have a file somewhere, if you looked at KCB and Equity Bank,
Yes.
uh, let's say in the period of ending 2020, these two banks alone increased the amount they've lent to the government to a tune of 100 billion.
Yes.
So they have liquidity. Really, when you're looking at a bank and you want to see and you want to see the challenges that will hit them, the first thing you look at is not asset quality, because asset quality is both an art and a science. It's hard to determine because it's based on at a specific point in time. The asset quality of a certain parcel of land today will not be the same asset quality tomorrow or the year next year. So what you look at is liquidity. Do these banks have liquidity? And the answer is simple: yes. The CBK raised 82 billion last week from the local market. There is liquidity in the market. The
Yes.
fact that people are able to lend the government to that extent, and most of them being banks and pension firms, and the pension firms do have their funds sitting in banks, tells you that the tier 1 banks, especially, because I can't speak about all banks, tier 1 and most of tier 2 banks have sufficient liquidity to be able to absorb and give their customers time, to restructure these loans. Because if your customer, for example, is facing a challenge, there are two ways to it. You either give him a moratorium or an extended grace period, which is what CBK directed, or two, you unlock the deadlock by actually giving them some more funds to unlock whatever project is stuck. So if it's a real estate project, instead of them relying on pre-sales to fund part of the project, you give them an additional loan so that the project can be complete, so that the buyers can actually now be liable to make the payment, so that the loan shifts from the developer to now you're giving the buyers mortgages. That's how you look at it. So the banks have sufficient liquidity to actually support their customers during this time. Now, whatever they are calling the 14%, which we are all in agreement is actually non-performing loans. Now,
Yes.
some of these we agree are in a very bad state, and the banks might have to take some losses. And as you and I have discussed previously, the banks have actually increased their provisions significantly. We've seen banks triple or even increase their provisions 4 times. If a bank was providing 2 billion a year, they're now providing 10 billion, which tells you they've set aside cash to cover for the potential loans that might go bad. They are not also accurate. There might be more, there might be less, but at least they have made those provisions correctly. But in terms of liquidity, the banks can actually run for quite a long time, some of them, without having to run into a cash flow problem. So they can go to, let's say, even 30% of their customers and tell them, we are going to give you 6 months without you having to make any payments to us. That's what I'm saying. Banks are actually have the ability to do that again in their own individual capacity. And we saw this coming from KCB without taking a big hit. Why? They have the liquidity in their balance sheets.
Pretty much, Gabriel. Let's move on to the last issue that we have for you this morning. We mentioned it briefly because we do know that petrol prices were expected from midnight today to jump to the highest level in Kenya's history because they were expected to jump by 4 shillings to 127 shillings and 11 cents per litre in Nairobi, while diesel was expected to shoot up to 109 and 96 cents per litre. Well, looks as if things are going to remain the same because what we do know is that APRA has actually revised that market margin for petrol. Let me just read what it is now. Yes, to just 4 shillings and 44 cents a litre, meaning that they're going to keep that unchanged. Again, diesel has also revised to 2 shillings and 28 cents market margin, meaning that we are actually also going to get it at that 102 shillings again for the next 1 month. That is as from April 14th all the way to May 14th. Meaning that, well, even as we cry over high fuel prices within the economy, there is a way, therefore, that they are not going to shoot despite high international fuel prices in the globe. Good. Gabriel, question is going to be, again, because that's what everybody is asking, that is it possible for even the current prices to be reviewed downwards? Because this is the highest level, again, that we're talking about since 2018.
Simba, so I think there is something that quite a few analysts might have missed in this sector.
Yes.
So one is that, and I can ask you, I mean, how many people have actually looked at Total's financial performance for the year 2020? Very few people have looked at it. But did you know that Total recorded at over 30% decline in sales? Yeah. So their sales declined from over 100 billion to about 65. But the funny thing is that their gross profit, so whatever is actually left to them, did not change. They actually increased their gross margin, their gross margin and their gross profit, and they also increased their net profit. So I gave up on this formula saying that it's actually designed to secure the consumer. It is not. Because what that tells me, the fact that a company like Total was able to make that much money, tells you that those prices we were paying last year could even have been at 30 shillings or 50 shillings per liter. Simple as that. Because there's no way you made 9 billion in operating income from making sales of 111 billion, and then you still make 9 billion in operating income from making sales of 65 billion. It's not tells you that that formula can, the prices can actually go low, but the vested interest from both fuel importers, from fuel retailers, coming down all the way to the government. They are all, because you see, these fuel stations are the government's collection agents. So the government has to keep them happy, etc. So it could come low, but they will not let it come low, because if there's any year they could have pleased us, Simba, it was in 2020.
Yes.
And they did not go as low as they could have. We thought at 80 something it was good, but if crude prices were negative, why are we paying 80? And then now from there to bring us all the way to 122, this is really what I'll call a political issue. And them not increasing it shows political interference, which can never result in anything good. When you see politics interfering in actually what should be a straightforward formula calculation, it's very wrong, because this is what happened with KPLC, and you know where KPLC is. When you bring politics into such formulas, then it's wrong, because what they should be looking at and what Parliament should be looking at is this formula. For example, the taxes. You cannot be calculating taxes on top of taxes. You cannot calculate VAT on top of inflation, on top of excise. It's wrong. It's incorrect. But they do that and they know it. So if they want to solve this and they want us to enjoy better fuel prices, let them look at the formula and let them be genuine to us. Other than that, just go look at all these entities. EPRA is making more money in a bad year, even when sales are that low. Total and other fuel selling companies actually made more money by working less. Simple as that. So it can go lower, but they won't allow it. They have chosen violence, in short.
Yes. Finally, then for this morning, Gabriel, I mean, we do know that we did get an extension from IMF, that 257 billion loan facility, and they did say that the other options could have been quite some strong austerity measures that the government could have actually relied on. And we do know some question that I got directly from one of our viewers is how much is this tied to the IMF facility that we received the other day? Just the uneasiness and unwillingness for the government to actually pursue energy prices in the country that are I would say, the highest in the EAC countries.
So one thing to understand about the IMF, and this is very unfortunate, the IMF focuses on revenues. So the IMF tells the government you need to generate more revenues. That means more taxes. And as much as they say you need to reduce expenses, you need to fire people, redundancy, etc., they don't really give a proper prescription for that.
Yes, yes.
Now, these current changes in the fuel prices are not yet affected by the IMF because we've not seen any new regulation. Whatever the IMF would propose would be an increase in VAT or certain levies, and that has not yet come. So this is purely market prices and the inefficiency in this formula, as I've pointed out. Now, the government, unfortunately, has not, by its own volition, been able to curb or control its expenditure. And that's what they know they should do. That's what they have been told throughout, but they keep making excuses. So that's done. Now, what the IMF will do, unfortunately, is focus on the short term. By short term, I mean 5 years. In an economy, 5 years is really short term. And they look at tax revenue instead of looking at, you reduce taxes, let's say for fuel, if we're talking about fuel, reduce the amount of levies in fuel, people are able to move around more, companies are able to use more diesel and work more hours, etc., and then the economy will actually end up being more vibrant. That's long term. The effect of that takes time. But IMF looks at, we want 5 years when we have this facility for it to work as much as possible. So increase taxes, etc. That's what they do. And unfortunately, Kenya has been suffering from one problem only: lack of savings. Starts with the government, flows down to the individuals. There is we do not have savings to actually invest in our own economy, and that is what is hurting us. So the fact that the government just keeps consuming, it's all consumption. You consume, and I'm not talking even about Simba and Gabriel. I'm talking about the economy. I'm talking about industries. I'm talking about sectors. We are all just consuming, and the worst is the government. The consumption by government is what is driving growth in this economy, and we will continue to suffer from that until we turn it around to become investments and savings that drive the economy at the government level. So until we correct that, all this IMF business is going to just hurt us, and we will see the rough measures that will come from IMF. VAT probably going to 16, and then Simba, a few of us will have to park our cars because then it's going to be ridiculous.
Pretty much. All right, Gabriel Mwendo, thank you very much for joining us this morning. Always a pleasure talking to you, sir.
Always a pleasure as well.
All right, and that's exactly what we have for you on Best As I Am today. Good morning.